You ever wish you had like a secret compass for the market? Something that tells you where things are really headed long term, cutting through all that noise from bank reports and just endless data. Well, that's exactly what we're going to do today. We're going to unlock a really powerful method to forecast major currency trends. We're talking 3 to 6 months out, all by using the bond market as our guide. Welcome to AI Explains ICT. Now, this video is a huge one. We're covering a key lesson from the core content, specifically month 3, episode 6, and we get into some pretty serious macro-level stuff. So I would really encourage you to grab a notebook for this one. You're definitely going to want to remember what's coming up. All right, here's the game plan. First, we're going to find what I call the market's hidden compass. Then we'll get into decoding the crucial relationship between bonds, interest rates, and the dollar. After that, we'll uncover the exact signal that smart money leaves behind, see it play out in a real case study from 2016, and finally, I'll show you how to forge your own long-term macro bias. So first things first, why do we even need a hidden compass? Well, the traditional ways of trying to figure out the market's long-term direction, they're often a mess, cluttered with misleading info and just overwhelming complexity. And that's the problem we're here to solve. You know, ICT just nails it with this quote. Think about it. Why would a bank tell you what they're really planning to do? It's like a football team handing over their playbook to the other guys right before the Super Bowl. It makes absolutely zero sense, right? Those reports, they aren't designed to give you a genuine edge. So the real challenge for most traders is trying to wade through this mountain of fundamental data. I mean, who has the time, or honestly, the expertise to figure out what actually matters? The great thing about the approach from ICT is that it just bypasses all that. We use a purely visual interpretation of the market's underlying forces, letting the charts themselves tell us the story. Okay, time to build our foundation. Understanding the mechanical relationship between these three things, bonds, interest rates, and the US dollar, is seriously the key that unlocks this entire concept. Once you get this part, I promise, everything else is just going to click right into place. First up, bond prices versus interest rates. This is a simple inverse relationship. Just think of a seesaw, When one side goes up, the other has to go down. So when the price of debt, like the 30-year Treasury bond, goes down, it means interest rates are going up. And on the flip side, when bond prices rally and go up, interest rates fall. It's just a fundamental market mechanic. Now for the second piece of the puzzle, interest rates versus the US dollar. This one is a direct relationship. It makes perfect sense when you think about it. Higher interest rates in a country attract foreign investment because, hey, investors can get a better return on their money. All that demand for the currency makes it stronger. So as US interest rates rise, the US dollar tends to get stronger too. So let's put it all together right here, side by side. This is the crucial part. For a bullish dollar scenario, here's the chain reaction. Bond prices fall. That causes interest rates to rise, and that strengthens the US dollar. The bearish scenario is just the exact opposite. This two-step logic is the engine for our entire analysis. Okay, so we've got the basic relationships down, but how do we get an early warning that a big shift is about to happen? This is where we bring in a very specific, actionable tool from ICT, the smart money technique, or what we call SMT divergence. Check this out. Up top, you've got the US dollar index, and on the bottom, the 30-year T-bond. Now, like we just talked about, they generally move opposite of each other, like a mirror image, right? But the really powerful signals, the ones we're looking for, they show up when this relationship breaks down. So, what does it mean when they stop confirming each other? That failure to confirm, that's what we call an SMT divergence. It's basically a crack in the normal correlation between two things that should be moving in harmony. And that divergence is often the very first sign that the underlying trend is getting weak and that smart money is getting ready for a major reversal. It's our heads-up display for what's coming. Theory is great and all, but let's see how this stuff actually works in the real world. We're going to jump in a time machine back to 2016 and watch step by step as a divergence in the debt markets perfectly predicted a massive move in currencies. And here it is. This is the exact signal. We're comparing the 10-year note with a 30-year bond, two key benchmarks for U.S. debt. Now notice back in late September, the 10-year note made a higher high, but the 30-year bond failed to do the same. In fact, it posted a lower high. That disagreement is the SMT divergence we're hunting for, and it was signaling that bond prices were likely to fall, meaning interest rates were getting ready to rise. So, what happened next? Well, exactly what our little logic chain predicted. With interest rates poised to rise, money started flooding into the US dollar. You can see it clear as day right here on the dollar index chart. Right after that divergent signal in late September, the dollar just took off on a powerful multi-month rally. The signal in the debt market was just the opening act. Now, knowing where the dollar index is headed is incredibly powerful. Why? Because it gives us a macro bias for every major currency pair. If we expect the dollar to rally, it means pairs where the USD is first, like dollar CAD or dollar yen, they should rally too. And pairs where the dollar is second, like the euro or the pound, should sell off. And here's the proof in the pudding. On the left, you've got the euro, on the right, the British pound. And just as we expected, during that same period in September, both pairs topped out and started a major decline, perfectly mirroring the dollar's new strength. The correlation was undeniable. And just to complete the picture, let's look at the pairs where the dollar leads. Here's dollar CAD and dollar yen. And no surprise here. They both found a bottom right around that September timeframe and then launched into huge rallies. That one little signal from the debt market sent ripples across the entire Forex world. Now, what we just walked through isn't just some cool history lesson. It's a repeatable process. It's a brand new, powerful tool that you can add to your own analysis to get a real edge in understanding where the market is headed long term. Let's boil this all down into a simple checklist. Step 1, you got to keep an eye on the 30-year bond and 10-year note charts every day. Step 2, you're on the hunt for those critical SMT divergences where one fails to confirm the other. Step 3, connect that signal to the dollar index and anticipate its next big move. And step 4, use that dollar bias to form your long-term 3 to 6 month outlook on all the major currency pairs. I want to leave you with this quote from ICT because it just perfectly captures the feeling you get when you finally understand this concept. Once you can see these inner market relationships for yourself, once you can read these signals, it's a type of knowledge that becomes a permanent part of your toolkit. It's like the market's code just gets a whole lot clearer. Hey, thank you for watching this deep dive with us. If this unlocked something for you, please do me a favor and like this video and subscribe to the channel so you don't miss out on what's next. If you have any questions at all, drop them in the comments below. A real human will get back to you. Until next time, safe trading.